Hey everyone, today we are jumping into the 2026 crypto market outlook. And we're using a really fascinating report from Coinbase Institutional as our guide. We're going to unpack some massive trends that aren't just changing crypto. They're actually causing this great convergence between digital assets and the traditional financial world. Let's get into how these two universes are, well, becoming one.
And really, the whole story can be boiled down to this one single question. For so long, crypto has been the outsider, right? A kind of volatile playground for the early believers. But all the signs are now pointing to a fundamental change. So what actually happens when it stops being on the fringe and becomes a core part of the system? To get our heads around this, we're going to look at four key areas. First, how the big, serious money has finally, truly entered the building. Second, we'll talk about a new kind of digital cash that's going to power an economy of machines. Third, how real-world stuff is moving onto the blockchain. And finally, we'll look under the hood. Is the tech itself even ready for all this? Okay, so let's kick things off with the absolute bedrock of this entire outlook, the arrival of institutional capital. I mean, this isn't just another passing trend. It's the foundation that everything else we're about to talk about is being built on. And this right here is the critical point to grasp. We are way past the institutional curiosity phase. We're talking major financial players, giant hedge funds, even publicly traded companies. They're not just dipping their toes in anymore. They are active, core participants, and honestly, the scale is just staggering. The era of them just waiting and seeing, it's over. And wow, this chart just says it all, doesn't it? Just look at the insane amount of money flowing into spot Bitcoin ETFs since they launched. We're talking over $58 billion in net new money. And let's be clear, this isn't just retail hype. This is a tidal wave of sophisticated capital, and it's fundamentally reshaping the entire market structure. So, how is all this happening? Well, it's really standing on three main pillars. You've got the spot ETFs we just saw, which are a super simple, regulated on-ramp. Then there's this concept of digital asset treasuries, or DATs. All that means is that public companies are now holding stuff like Bitcoin right on their balance sheets, just like any other corporate asset. And maybe the most important piece of all, we are finally getting some real regulatory clarity. You know, what's so interesting about this slide is that it shows a clear, intentional path forward. Big institutions hate uncertainty, right? They need predictable rules to play by, and that's exactly what's being built here. You've got things like the Genius Act, which creates a real framework for stablecoins so they can be treated like regulated money, and the Clarity Act, which finally starts to define what different digital assets actually are. The US is creating the guardrails that give big money the confidence to get off the sidelines. All right, let's move on to our next pillar and see how this all connects. So the institutions are bringing the capital, but where is it all going? A huge part of the answer lies in creating a totally new kind of money, one that's designed not just for you and me, but for machines. Just take a look at this number. Let it sit there for a second. $1.2 trillion. That's the projected market cap for stablecoins by 2028. It's a colossal figure that signals we're seeing the rise of a new global digital cash layer. And this chart shows you that growth curve. It's not just a straight line up, it's exponential. Stablecoins are evolving from just a tool for traders into essential market infrastructure. They are, in effect, the programmable, instant, borderless dollars that are going to fuel the next generation of the internet. Which, of course, brings us to the obvious question. $1 trillion in digital cash is, well, it's impressive. But what's the killer app? Beyond trading, what is it actually going to do? The answer is pretty wild. It's going to let our machines pay for things all by themselves. And this is how. Meet the X402 protocol. This is a critical piece of the puzzle. You can think of it as an open payment standard designed specifically to let AI agents and automated systems send tiny, instant payments to each other online with zero human intervention. It's basically a language for machines to talk about money. Honestly, the easy pass analogy is perfect. Imagine your AI assistant needs to pull some data from a service to answer a question for you. Instead of you having a monthly subscription to that service, your AI could just use the X402 protocol to instantly pay a fraction of a cent for exactly the data it needs, right at that moment. This just blows the doors open for a whole new economy of micropayments, powering everything from AIs to your smart fridge. So we have institutional money pouring in, and we've got a new digital cash layer for machines.
Our third theme is all about what else is being pulled into this new financial system, and that's tangible, real-world value.
Now this is where things get really, really interesting. This chart shows you what kinds of real-world assets have been tokenized or brought onto a blockchain. And the single biggest piece of that pie, by a long shot, is U.S. Treasury debt. Just think about that for a second. The world's safest, most foundational financial asset, U.S. government debt, is now becoming a native building block for the world of decentralized finance. This is literally the bridge being built between the old world and the new. So why would you do this? Well, the benefits are just immense. For one, you get markets that are open 24/7 and settle almost instantly, not in 2 days. That makes capital way more efficient because money isn't just sitting around waiting for a trade to clear. It can be put to work right away. It also means you can use things like tokenized treasuries as ultra-stable collateral inside DeFi protocols, which makes that whole ecosystem a lot safer and more robust.
Of course, none of this is even possible if the underlying tech can't handle the load. Which brings us to our fourth and final pillar, the maturation of the core blockchains themselves. This is the engine room where all this innovation is actually happening. Let's start with the original, with Bitcoin. For its entire history, its price has been famously driven by this predictable 4-year halving cycle. But that whole dynamic is starting to change. The future of Bitcoin's value seems to be driven less by its programmed supply shocks and way more by the persistent, stable demand from those massive institutional ETFs we saw earlier. It's really a sign of the market growing up. And this evolution is happening all over the place. While Bitcoin settles into its role as an institutional asset, Ethereum is going through massive upgrades to get faster and cheaper, preparing it for mainstream levels of traffic. At the same time, a network like Solana is really maturing beyond its reputation for meme coins and becoming a legitimate enterprise-grade network for apps that need lightning-fast performance. So, let's tie this all together. We've talked about 4 powerful and pretty distinct trends, but the real story here isn't about any single one of them in isolation. It's about how they are all merging and actually reinforcing each other.
You know, this quote from the report just sums it up perfectly. The institutional money brings the capital. The regulatory clarity brings the confidence. The tokenized assets bring the stable collateral. And the maturing blockchains provide the actual rails for it all to run on. It's all one big feedback loop. This is the great convergence. We're watching this space transform from a speculative niche into a foundational piece of the financial system. The lines between traditional finance and digital finance are blurring into one single, interconnected future. So this convergence, it's not a question of if anymore, but when. The only question that's really left is, how are you going to adapt to it?